capital structure analysis, financial leverage analysis, financial risk analysis. Friends, I am sure every one of you in last 3-4 days must have heard of a company called Evergrande in China, and this company is on the verge of making default in paying its obligations on the debt which this company has taken. I am sure you must have also read that this company's annual income is $100 billion. $100 billion. And what is more interesting, that this company's debt is $305 billion. $305 billion. And you can imagine a company of the size of $100 billion having a debt of $305 billion is bound to be in trouble. Is bound to be in trouble. And that is what is happening. And remember, today there is a lurking fear globally that in case if Evergrande goes down the tube, it might create a similar kind of ripples which Lehman Brothers did in 2008. And therefore, friends, as financial analyst, as valuation professional, as investment analyst, as CFOs, as finance controller, as investment banker, as merchant banker, in any of those roles, it is absolutely imperative for every one of us to be absolutely clear about the financial risk analysis. And please understand at the same time, across the globe, and we have seen more here in India, across the globe, companies that down the shutters are the ones which had very high excessive leverage. Lehman Brothers went down the tube because of excessive high leverage. And that is why, friends, it's absolutely necessary for every one of us, as also the valuation professional and accountancy and the finance professionals, to understand as to how to analyze the financial leverage or the financial risk. And that is the discussion that we have now. Now, if I have to find out the financial risk of a business, financial leverage of a business, what I can do, I can look at a ratio which is known as debt equity ratio. And what do I do for the debt equity ratio? I take the long-term debt and divided it by equity, and what I get my debt equity ratio. Now, a lot of people say as to what is an ideal debt equity ratio. Now, let me tell you, friends, as far as the lenders are concerned, there can be an ideal debt equity ratio, which globally is considered to be 2:1 for a manufacturing company and 8:1 for an infrastructure company and also for a banking company. But as far as the borrower is concerned, there is nothing called ideal debt equity ratio. And why there is nothing called as ideal debt equity ratio for a borrower? Because for a borrower, the debt equity ratio will be depending on how is the EBITDA of the business. So if the EBITDA of a business is extremely high, then the debt equity ratio of this company can also be very high. And why the debt equity ratio of this company can also be very high? And that is because this company's EBITDA is strong, and therefore this company has the capability and the ability and the competency and the resources to take any amount of debt and use it for the purpose of expansion, diversification, modernization, debottlenecking, whatnot, thereby earn more revenue and thereby earn more profit and thereby further increase the EBITDA. But if a company's EBITDA is weak or negative, now in such a case, this company's debt equity ratio has to be negative. And when I say has to be negative, that means what? That means this company should remove the reliance and dependence on the debt, and this company should have more equity in its capital structure. And that is how you will calculate the debt equity ratio, and that is how you will interpret the debt equity ratio. So please remember, for a lender, for a lender giving money to a manufacturing company, 2:1 is considered to be okay globally by all the lenders. For for an infrastructure or a bank, it can be 8:1. But as far as the borrower is concerned, for a borrower, there is nothing called an ideal debt equity ratio. For a borrower, the debt equity ratio will depend as to what is the EBITDA of that business, and depending on the EBITDA and the quantum of the EBITDA of that business, looking forward, going forward, the debt equity ratio of that borrower can be decided. Number two, what you can calculate for calculating the debt for financial leverage or the financial risk analysis is the net debt equity ratio. Now, what is net debt equity ratio? It is a slight variant of the debt equity ratio. In case of a debt equity ratio, what you do, you take the total debt. In case of net debt equity ratio, what you do, from the amount of the debt, you will minus the cash and cash equivalent. That means the money which is available with the company, you will minus that amount from the amount of the debt and take the net debt for calculating the net debt equity ratio. In my view, it doesn't make much difference, but globally, this is a very commonly used indicator for evaluating the financial leverage. Number three, you can calculate the total debt to equity. And friends, this is what I will very strongly recommend, that if you want to find out the financial risk of a business, don't look at the debt equity ratio. Look at the total debt to equity ratio. And why total debt to equity ratio? Please remember, total debt का मतलब क्या है? Total debt का मतलब है, debt can be of two types. Debt can be of number one, which is interest bearing, and number two, debt which is not interest bearing. So if you take a loan from a bank or from a financial institution, you will pay interest on that loan, and that is your interest bearing debt. But you may have certain long term liabilities on account of employee benefits, on account of some long-term purchases that you have done of plant and equipment. Now, though that also should be taken into account, friends, for the purpose of calculating the real debt equity ratio. So the real debt equity ratio will be the total debt to equity ratio, and that is what is more dependable, more reliable, because just because a debt is not bearing any interest, it does not mean for the purpose of finding out the financial risk of that business, you must remove that debt. No. Take the total debt, total long-term debt, which is interest bearing as well as the non-interest bearing. Because that is the better reflector of the actual leverage of the entity. And number four, that you can calculate this equity to asset ratio. And how do you calculate the equity to assets ratio? So you take the equity of the company and divide it by the total assets. So if you take the figure of total equity of the company and divide it by the total assets, so depending on how this ratio is, if this higher the better. So higher the better meaning what? If this ratio is high, that means a larger part of your assets are funded by equity and a smaller part of your assets are funded by debt. So you can calculate equity to asset ratio to find out the financial leverage of a company or financial risk of a company. Now, before I move forward to the last topic of the day, and that is market valuation ratio, I would like to do a small case study once again with you to understand, friends, as to why do the businesses borrow money. And I'm sure this is the question that I would like to ask all of you, and then we take a small case study to understand as to why the businesses borrow money. And please remember, borrowing has got a direct relationship with the valuation, and I'm sure you can understand. In the market today, we have Bharti Airtel, we have Reliance Jio, and we also have Voda Idea, three telecom player, and today all these three telecom player are of course having a large subscriber base. But if you look at the market price of these three telecom players, you will see there's a huge difference in the market price of Bharti Airtel, market price of Reliance, and the market price of of Voda Idea. And why is that? And that is because Voda Idea is hugely in debt, and that is why today Voda Idea share is quoting about 10 rupees. As a matter of fact, it was quoting at rupees 6 per share before the government of India made announcement for a package to help the telecom sector. From 6 rupees it went up to 10 rupees. But whereas the share of Bharti Airtel is at a much higher figure than 10 rupees. What is the conclusion that you draw from here? The conclusion that you draw from here, that a highly leveraged company not supported by its EBITDA will have a negative bearing on the valuations of the business, and that is what we need to remember and understand. So we take that case study, and I would like all of you to give me your responses. And I can tell you at this point in time, friends, बहुत सारे लोगों को लगता है companies borrow money because they do not have. And let me tell you, friends, companies do not borrow money because they do not have money. Companies borrow funds because of 16 different reasons. And that is what we will understand in this case study now.